Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, January 31st, 2024. It is 9:32 a.m. Eastern Time. I wanted to wait till the market opened. We can start going over things to watch this week. What I'm going to do is keep this primarily focused, if not solely focused, on the equity markets. Quick reminder, we're in the thick of earnings season. This is peak earnings week. We had Alphabet and Microsoft report last night. And we're going to have the next two big ones, or three, coming up. And these are part of the MAG, what I formerly call the MAG 7. Amazon, Apple, and Meta all coming up tomorrow after the close. So I wanted to do a quick update on one of the couple others. There's a lot I want to cover here. I'm going to get to IWM in a second. I want to make sure I do an update on the small caps. But about last year, maybe it was maybe a year before, I started building a watch list that I keep an eye on one of my monitors called the Things to Watch, my TTW watch list. And in there I have two of the best leading indicators, two companies that are considered some of the best leading indicators of the economy. A leading indicator is something that can kind of give you a heads up. Concurrent indicators, or coincident indicators go up and down, like consumer sentiment. I often talk about that. Some might refer to it as a leading indicator, but to me, you could look at the charts, it goes up and down with the stock market. The two that reported, before I get to small caps here, I'm sorry, I know at least one of these reported. I think it was UPS, but UPS and FedEx have always been bellwether stocks, and if you will, canary in the coal mines for the economy. Usually they track very well together. You can see UPS got the snot knocked out of it the other day. I believe that was the earnings right there, and this week. And FedEx, I don't believe, has reported. I may be wrong. I didn't check. I just noted UPS reported the other day. And when you go back in time, what you have here is this is FedEx, which has a longer trading history than UPS. You can see a perfect, and I mean an almost perfect correlation. Again, the lines aren't going to overlay because they're moving in different price increments and all that than the stock market. So what I've done here is that's SPY in green and FedEx here. It's a weekly chart, so we can go back to the 90s. And then what I've noticed, and I've noticed in the past, we're going to pull in. There's been, in my opinion, three previous to the 2022 bear market, or even COVID, if you want to call that a bear market, the two real bear markets that no one will dispute whether they were bull or bear markets because they lasted long enough. Remember, COVID certainly met the definition, 36% drop in the S&P 500, but it was over in 6 weeks. So you had the bear market back in the 90s, the dot-com bubble, 2000 to 2002, and then the 2007 to 2009 bear market. So what we're going to look at here, I'm going to pull in real tight and just show you the divergence here. Again, these guys will mirror each other, the FedEx or UPS in the stock market or the economy as well. And it makes sense. Think about it. Packages being delivered, whether you're buying gifts, buying purchases online, having delivered, or closings on mortgages and other financial documents that have to be sent via FedEx and all that. So obviously it's very clear why these ebb and flow with the economy. I don't think that needs to be explained much more than that. So you can see here, there's that big run up. Remember, down below is FedEx run up, and it peaked right here at the crosshairs in the white. It peaked on mid-June. That's that's the week ending Friday, May 14th, 1999, and then clearly started trending down. In fact, you can see here the S&P 500 and the NASDAQ, they all went up. It was March of 2000 when that was when the tech bubble burst. And just measuring it out here, I believe this tool is correct. If I have to double check it. I meant to do that before this video. Started working on this one yesterday. That's the drop. It's showing in percentage terms, 62.5%. I can't remember. I know the NASDAQ dropped over 78%, I think, the NASDAQ composite. But either way, you can see the big bear market, and that was one of the most powerful bear markets really in history after the 2000 bubble. And, bigger the bubble, the bigger the run-up, usually the bigger the drop. But you can see, again, the most important takeaway is FedEx clearly showed it had rolled over, meaning they were shipping less things. And again, so when I said a minute ago, they tend to move together in sync, and they do. And you can please do this, study this chart on your own. There are rare periods of divergences, and that's what I look for. Divergences, you hear about all the time, positive or negative divergences on the indexes or a stock or gold, but it's just the same takeaway on indicators, breadth indicators, or in this case, divergence between a particular key stock that is indicative of the how the economy is doing and the stock market as a whole. So there it is. Again, you can replicate these, but you can see FedEx back here peaked in clearly, and it wasn't just a little blip. I mean, you're going to see temporary disconnects, but when you see FedEx in this case fall, leading up to while the stock market still was ripping higher. And at that point, FedEx had fallen, if this measuring tool is right, 43%. Again, I may have to double check that by turning off the comparisons. But either way, you can see it's pretty substantial, and I think that is correct. That was a tell right there. It was a heads up. It was a canary in the coal mine. All right, let's just fast forward to the next one. Got to do this, and now pull it back and go to the next bear market. And I won't go into this much detail in UPS. I'll just show you the charts, and you can see they look the same. So here we go. You can see the years below 2009. So now we're going to scroll in a little tighter here. Again, this is when the stock market peaked. That was October of 2007. Both the NASDAQ and the S&P 500 synced together. They topped in. Then we had the financial crisis. Again, one of the biggest bear markets in history, a roughly 55% drop, a little better actually. I think it was like 57 on both from top to bottom. But again, you saw the same thing. So you saw the S&P, especially towards the end. The strongest advances always come in the end. Obviously, we've got some pretty excited bulls on the site and on TV and everybody, and the analysts now, a lot of pundits saying, forget about the soft landing. There'll be no landing. Things are screaming. The economy's bulletproof. Blah 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 blah. That's what tends to happen. You get those big advances, but you can see again in this case, FedEx clearly peaked. It almost pretty much peaked back in 06, but had a marginal new. So let's just go off the official high right there. But that was February. Quite a bit. What is that? Better than 9 months or so before the S&P peaked, and it was clearly moving down in a downtrend and not just even going sideways. So again, it kind of stalled out there. So that was a tell. Again, you can do this and go over all the other periods. The bottoms came together each time. And so that was then, this is now. So this is the chart right here. Here's the FedEx right there. I'll get to a chart in a second. There's the peak. And that was in week ending December 15th. And look at that drop right there. So that was that's 15%. And here's the S&P. So this is the divergence. You can see almost, again, go back in time. They marry each other. And I'm trying to use an arrow tool. Look at all the turns, the peaks, the troughs, and up until this point. So this is where the divergence started. FedEx peaked and has clearly been falling, as has UPS. Here, we'll go over to a daily chart. So there's FedEx. There's the top right there. Clearly a peak. UPS as well. These guys are just, again, there's so much evidence out there. And here, let me say this, guys. I know there's a case to be made, a bull case. If I sit here all day and cover all the things that are bullish and why the market may continue to go up for the next 2 years, 3 years, and then I sit there and spend as much time telling you why it's going to go down, all the bearish things, and at the end of the day saying it's going to do either, I don't think that does anybody any service. My job, I don't mind making calls. I don't mind being wrong. I'm going to process all the evidence, take it collectively, and then give you my opinion. And if I don't have an opinion, and I think if you guys use the comment section, you'll get that a lot from me. Hey, Randy, what do you think of Nat Gas right now? Or what do you think XYZ company? If I don't have an opinion, I'm not going to give you one. I'm not going to force an opinion. I think that does an injustice. If I say, oh, this looks bullish here, or this looks bearish. No, it's right now I don't have an opinion. Feel free to bump me later. But I have a strong opinion on the economy and the market and where it's going. And the case has only gotten stronger is why I'm doing this and why I'm talking about. Here's UPS. Again, one of the tells, if you will, of bellwethers. And that's, from high to low, 41%. Let's just go from the peak. When it peaked back in the end of 2021, it is still down 38%. And again, you can go back in time. I'll do it right here. And this is that weekly chart. So you can see UPS came public back here in 99. That's when we started trading. You can see the almost perfect mirror, and you can zoom into those periods. And just like FedEx, you will see those rare but very clear divergences where these stocks peaked, and well in advance, usually within a year or so of the stock market. And now you can see that divergence. And on record, I haven't seen such stark divergences we have here recently. So I just wanted to cover that one because again, it was the earnings the other day on UPS made me take a look at those, and they've been in my things to watch list for a long time. Okay, let's get to all the other stuff. IWM, small caps. Remember, this is a long-term swing trade, if you will, or trend trade. This is the weekly chart. You can see it very clearly on the weekly, but you can also see it on the daily. We had this trading range at the top. We had a false breakout. That breakout occurred with a negative divergence and overbought conditions. As said it at the time, and I say this often, breakouts that occur with negative divergence and overbought conditions have a much, much higher failure rate. A failure rate I would put in well north of 80%. So then not all of them fail. Sometimes they can power through there. If there's strong fundamental catalyst, a lot of buying pressure behind it, it can overwhelm the technicals. Nothing is 100%. If it was, nobody would be working. We'd all be using that 100% accurate indicator. But that happened. Then we fell, right back down to the bottom of the range, which is typical once a breakout fails. After several failed attempts to get over there before, false breakout, that's more bearish than just a rejection off resistance. Because you have a failed breakout. You have short sellers that got squeezed out and have given up on IWM. Longs, bulls are buying like they are right now. And then boom, that changes the holders, if you will, of that security at the time. And again, by blowing out short interest and sucking in hot money, folks that chase the breakout, and then everyone that bought the breakouts immediately underwater, and that's where you get this. So you got that big red candle to confirm that breakdown. If you weren't already short off the divergent high, which I believe we were back then, we had probably sell signals on the 60-minute or daily. That was when you wanted to get short. If you missed that, it's highlighted. We had numerous back tests if you missed the breakdown. And so that's it. You either short a breakdown of support or you short a rally back to resistance. And then we went down. But point is, since then, we've been in this big sideways, almost a comparable trading range, but on steroids. It's the same kind of range. It just is bigger in scope and magnitude. So scope and duration. And there it is. And as I highlighted here recently, when we were coming up, said any breakout that occurs is likely to fail. And if so, that's going to be an objective short entry. And there it is. So we had that short entry there, and I just wanted to highlight it. Again, we are back testing at level. So there's no guarantee that small caps aren't going to break out and run. But what I can guarantee you, and I give very few guarantees in this game we call trading and investing, I can guarantee you I believe this is a very objective short entry. Whether it pans out or not, shorting the top of this range, especially following a false breakout, is objective. And the top of the range, here it says 199, it says 198.99, call that 199 or really 200-ish. That's it. And then the thing is, you can, what's really nice about it, you can set relatively tight stops because it shouldn't pop that. If it does, you could give it, I can tell you right now, there's nothing wrong with a stop above 209 because that is also massive resistance. It was the bottom of this trading range, and then it became, that was support. Support broke and became resistance. And to try to quantify it, that's going to be from the top of the range, only about 5%. So you could certainly, if you are targeting my next target, which is T4 down here, the trend line, give yourself that 6% or so stop. And, if that's hit, it's 144 in the intersecting trend line. That's about a 28% drop. Very objective, nice risk reward, better than about a 4-to-1 RR right there. So there's IWM. Just wanted to reiterate. This is a 60-minute chart. This is where you got in before the breakout even failed. There's a little wedge break there, negative divergence on the 60. And this is swing trading, active trading. So this tells you, even if you're a longer term trend trader, you may want to incorporate these 60 minutes into your trading. If you were, let's say, scaling into a position, or you missed the failed breakout, or you missed the little breakdown here, you might want to hold off when you see the positive divergence here, because that's what gave us this little bounce. But I believe that's played out. And guess what, guys? Here's a little gift for you. Negative divergence now. As we backtest resistance, as I just showed you on the weekly, and here's the daily right there. So, okay, enough on IWM. Either it pans out or it doesn't, but I like that one. And again, you can either, I like it as a much longer term, deeper trade, but you can decide whether you want to just keep, active trading off the 60-minute time frame here. Probably give you a little wedge as well. Yeah, right there. And we're right at support right here, about 196.70. You can see quite a few reactions. There was a gap there. Then the top of the gap became support. Once we entered the gap, we backfilled it, but then that continued to act as support and resistance. So if you want to be safe, maybe a break under today's lows will take out, it will clearly have taken out that level right there. All right, next up, QQQ. I was on a 60-minute time frame, so that's where we're at. We just broke that 423.63-ish support right there. I also, on my futures, I'll try to get to those in a second. I'll try to remember. I had a little uptrend line there on the futures, and that broke. And it almost looks a little head and shoulder-ish, but it's such a small time frame. I really like to see head and shoulders on the daily or weekly charts playing out over weeks or months. But either way, it was a pretty clean, little small micro, near-term uptrend line and then price support. Look, we also have, I should have mentioned, but I think, we have the Fed today. The Fed is going to be like Apple, Amazon, Microsoft, all the Mag 7 reporting at once. That's the potential, again, to move the markets if they status quo. But we'll see. Remember, the markets had baked in the cake a March rate cut, all the rate cuts starting then. We'll see what the Fed says and does to, either reinforce or change that trajectory of the dot plot. But either way, technicals say, to me, even though it's earnings, the risk is to the downside. And to me, it's worth being short. I've told you for a couple of weeks now, I've got quite a few indirect hedges. And like I did close out that Bitcoin yesterday or the day before, like I told you. And good thing it's down today. Let's see. Let's go to daily chart. Nothing's changed, guys. If you followed, unless this is your first video in a long time, the technical posture remains the same. The big divergences, I remain, pretty confident that coming out of this peak earnings week and the Fed meeting, that the next trend will be to the downside. That we are probably very near, if not already after a significant turning point in the market at top. But we'll see. Somebody asked yesterday, I think it was, about the semis. Hey, you didn't cover the semis in the last video, the one that I did day before yesterday. He, asked about two particular ones, and I did look at them, and then the sector as a whole. And I said, in my opinion, down, down, and down. The whole lot of them, all the semis. In fact, I gave you an objective short on it the other day, and that's right here. With that bearish engulfing candle on SOX right there, and said it's one of my favorite sell signals or trading opportunities. When you see a bearish engulfing candle, which we had, it's simple. You short, especially after a prolonged uptrend, and especially when you can make a case with the negative divergences, the foaming at the mouth bullish sentiment right now, and for months that everyone's had in the semis because they've gone up. And that's the bearish engulfing candle. So far, nothing but red sticks. I mean, we had 1 day of consolidation there, but we continue to move lower. So that's working out. And, at some point, the next sell signal needs to come. It may just be a pullback. And again, I know there are some, here on the site, they're pretty vocal about being bullish. Particularly one person, buy everything. I'm going to buy everything. Buy the dip. This market's going to keep going up. And I did this for you recently with Apple. I said it's one of the best buy signals I've seen in time now. And I did buy it, and I put it on the site as a long trade idea, and we bounced, we gamed it. And but the point I was trying to make, and I said back then, I said, if you are, that was right here, if you are longer term bullish, that was off this divergent low, then this is, and I use the words, the best buying opportunity I've seen in a long time if you believe Apple's going to the moon. I said, me personally, I don't. I think it's going up, and I gave you 2 price targets, both of which were hit. And that the case was the oversold readings on the daily chart, everything else. But I also figured it was just going to be this. And in a bear market, buying oversold is typically good for a bounce, and that's about it. Just like in a bull market, overbought is good for maybe a short pullback if and when you align with other. You need a sell signal or buy signal. We didn't just randomly buy Apple only because it was oversold on the RSI. We bought it because it had positive divergence and it fallen to good support. And it double tested that support. Well, it hit the first target after the initial entry, came back, gave you a second. If you missed it, second guess the trade, you had another opportunity there. I said it could easily fall down to the bottom of this support zone we were buying it at, and it did that. And then it went up there. And right now it's coming to back test. Remember, they're going to report tomorrow night. And so what I do, and I did the other day, I tell you where I think the major stocks are going to go after earnings. And everything I see is the same. The semis look headed lower. And maybe, again, I'm wrong. And I'm giving you the levels to watch. It's going to increase the odds. Here's a beautiful little uptrend line in QQQ right there. Right? And so break of that uptrend line should open the door. We've got some support right here. I'll put a line up on the chart. I know this is a busy chart. This is what I call my busy board, my main board. I just have a lot of levels, and these are still intermediate term swing targets. We already hit the first of 2, and then my weekly chart, of course, I have even deeper, bear market downside targets. And as I've been saying now for many months, it's these purple lines. Really, if I have 2, it's the last of the 2 that I think will seal the deal and increase the odds substantially that we're going to hit my deeper, longer-term bear market targets. And so I'll go over those again real quick for you. So there's QQQ. Look, we're still fresh off all-time highs, so there's nothing to get excited about if you're bearish or short. And if you are bullish, again, please, and I'm not saying this to just say it, if you want to take some value in this site because you see things a different way than I do, then I'm giving you key levels that I think levels that will break, and I would look to objectively add to any. If I'm planning, I'm just speaking generically for you guys. If you plan to short or add to shorts, maybe you want to scale in, maybe you're a little cautious right now, then these are levels that if and when broken will open the door for the next move down, or should. And likewise, bulls can buy these levels if you're looking to buy a dip. Maybe you're very bullish, but you don't want to buy every little pullback. You want to wait for a little bit better correction. Again, those are your levels. Okay, let me just quickly go through the fangs. Microsoft is now, this is the uptrend line here. This is a daily time frame. As of now, earnings are out of the way, and it's a sell signal. So the day isn't over when trading on a daily time frame, which, again, you got to take everything right now with a little bit of a grain of salt, because the Fed today and then Apple and Amazon on tomorrow after the close. So what I'm trying to say is breakdown, buy or sell signals on any individual stocks or even the market have a considerably higher rate of failing because there's so much market moving news in the next 2 days. However, the charts tell me clearly that I think the next big move is down. And if you want to just take it on faith, a sell signal is a sell signal. Now, the takeaway is you may not want to go all in. Let's just say you want to trade Microsoft. You want to trade directly, shares or options. Well, that's a sell signal. That sell signal, you can either take it on the initial breakdown, which we now have, or you can wait for a solid daily close below that uptrend line right there. And that's just going to increase the odds that the breakdown will stick. Also gives you a less favorable entry. There's what it looks like on the 60-minute chart. All right, let me go over the rest of them real quick. Purple lines are still way down here. Remember, this is where back in the fall, we posted covering all shorts and going long because we hit these levels. I also at the time said if we break them, then that's where I'm going to go hard short, kind of tuck away for that big, next bear market wave down. But instead we hit them. As I pointed out, they were support. The 200-day moving averages, you can see right here, the red line and the blue line, everything, all these big fangs, they were the best buy signals we've had, pretty much in, months, at the very least. And there it is. So sell signal now on Microsoft. Nothing to get crazy about. We'll get a little more crazy about it after the Fed and after Apple and Amazon tomorrow, especially if it's still there. So what I'm doing also, guys, I have kind of a mental thing in my head. The MAG, we'll just call them the MAG 7. So you have 7 check boxes, right? And the more check boxes, we already know, I call them now the MAG 5 because Tesla's dead. Amazon's still well off its highs from over 2 years ago. And so now it's really the MAG 5. And one by one, the more of these I can check off, the more sell signals we get. Now I'm referring to, forget about these guys peaking. In fact, Tesla just hit support and it's beat down. I'd rather, at this point, there's much, much, much more meat on the bone for a short on Microsoft or Apple or any of these than let's say Tesla, in my opinion. So Tesla's died. But what these check boxes are for, as this week ends and we get into next week, the more of these below these support levels I'm covering right now, like this trend line right here on Microsoft, if we have the majority of those MAG 7 on sell signals, then it's going to greatly increase the odds that we're going to get that much more downside in the coming weeks to maybe even months. Okay. Apple, again, Apple already peaked here, already broke from a bearish rising wedge. They're going to report. I'll say it right now, and I said it before. It can go either way. The initial reaction, don't ever put too much into the initial reaction. Should Apple pop up after earnings, I feel strongly that it would be a fleeting pop to new highs. What I can guarantee you, unless it goes like up to 300, it's not going to go to 300 a share. If it goes up here anywhere from 205, 210, you can look, the indicators are lagging. And again, that divergence can be shown through on the weekly chart. You can clearly see the divergence. So any new high, even if Apple goes up 10, 12% post earnings, is guaranteed to simply extend these big divergences that have been building. And I've shared Apple, this many, many times. These are all the divergent highs for decades, and you can see the drops: 82%, 42, 62, 45, 34, 39, 35, 32. And this will be one of the biggest divergent highs really in history of the stock. So that's why I have the targets that I guarantee you there's very few out there, if any, that have such aggressive targets on these big, beloved MAG 7 stocks that I do. I think Apple, if it hits my, right now, I'll just say, well, yeah, it is. No, it's the same. My bad. It's always been since before the stock top back here. The current final long-term target was either 82 and or the uptrend line. So right now the uptrend line comes in higher. That's the primary secular bull market uptrend line. It's going to come in with this 105 support right here. If things play out the way I think they do, this is a key uptrend line as well, and Apple's right on the verge. So this is what I think is the most likely scenario. But guess what? We'll know soon. There's a lot of optimism about their earnings coming out. We all know these guys manage earnings. They're all they almost always beat. I can't remember the last time any of these Mag 7 missed. It's it's a $1 trillion business. Each one of these companies on just simply managing earnings and using financial shenanigans, including but not limited to stock buybacks and other things they can do in the book. So expect a beat. I mean, anything other than a beat would be catastrophic probably for the stock. But who was it? Alphabet and Microsoft also beat yesterday, but they got sold off into it because they didn't beat enough. That's what the game is all about now, especially when you get real high like that. So either way, there's the purple line right there on the weekly, but it's the daily I have down here. Those are your levels for Apple. So so that's it. If it pops, like I said, we'll kind of step back. It'll be a new divergent high. We'll kind of recollect. It's going to bring the indexes up if it does pop up. And if it drops, then here you have the levels that I think will, let me just zoom in and give you other, I'm going to pull this line down right now and update my levels. So you can see two reaction lows at about 180.30-ish. So call that 180. That's a key support level that should open the door to more selling. And then again, the purple lines are down here. Really, the line in the sand there is about 166-ish. That's where it's lights out, in my opinion, for Apple and the market. Alphabet, there's what happens on an earnings beat when the stock has already priced it in and then some. Little blow-off type top, divergent high, and the stock is down 5.7% today. It's basically backtesting. So again, to the for those that are bullish now, that I would tell you, I actually want to ask you, how would you not be buying this? And it's not it is a rhetorical question, obviously. There's nobody answering me right now, but this is an uptrend line and a pullback to test the breakout. These were your previous highs right here, and this is a breakout. And so what happens, TA 101, you either take a breakout or you buy a back test of the breakout. So that's the bullish scenario. It is not what I think will happen, because these are big multi-month, even year-long divergences, and they carry all the way out to the weekly chart, and heck, probably even out to the monthly time frames. If I wanted to, I haven't looked at the monthly. There's a monthly. This is what we call a secular bull market at Alphabet. It's had plenty of cyclical bears within there, like that peak. And like everything, sooner or later, all these secular bull market uptrend lines are going to break. In 2002, when market bottom, we just tested a lot of those. The market and a lot of key stocks tested those levels. And maybe we do get this. Maybe this thing keeps going for a couple of years. That's certainly possible. Anything's possible. But what I'm trying to say is just watch those levels. And it all starts out with breakdowns first on the weekly. Really, it starts on the 60-minute chart or the shortest term charts. But this is what my weekly chart of Alphabet looks like. You have that up, beautiful wedge right there. And a well-defined uptrend line, just like you had a wedge, well-defined uptrend line there. Divergent high, the stock fell from that point, which I still consider the initial leg down in bear market, about 45%. Hence, I don't think my 50, just to retest those lows would be another 45% drop, because we're back to where we were. There's a lot of these stocks, the ones that have equaled or made new highs, and again, the majority of stocks in the stock market have not. So collectively, the stock market, this, even if you want to be literal, could still be viewed as a bear market rally. When the majority, 50% or more of the stocks, the indexes, the equal weighted, all are clearly above their previous highs, and then it's you have to look for the next bear market if you want to, again, be all literal about it. But those are your levels, and that's kind of long-term stuff. In the near term, this is what Alphabet has to do, is take out about 138 and the trend line there. And then, of course, my purple line's down here. Amazon still, again, kind of left the mag. It's not so magnificent. This is the highs. It put a double top high back in 2021. And so we're in 2024. So that's why this stock, like Tesla, is no longer, in my opinion, we'll call it, it's out of the Mag 7, which is now the Mag 5. And there it is. Remember, they're going to report tomorrow. So it certainly has the fundamentals, or the post-earnings reaction can overwhelm the technicals. But, if I'm a betting man, which I am by nature, based on, what I do for a living here, I would say that whether the initial reaction is positive or not, that the next double-digit move will be to the downside. And again, we have a little sell signal here, but I would always take that with a big grain of salt pre-earnings. Remember, the other one I covered, Alphabet, Microsoft, they already reported. Amazon hasn't yet reported. You can take it on faith if you want, but I would only take a starter position. Again, if you're interested in shorting the individual stocks. To me, it's just, why not use NQ or QQQ? You have, even though they're very concentrated in their top holdings, you at least have diversification. You're not putting all your eggs in one single stock. Because I have seen areas where the market either bottomed or topped, and just one of the things went the other way than the rest of the lot. Eventually, it will get pulled with the herd just due to that indexing effect. But again, it's just risky to play stocks into earnings. It always is a crapshoot. But I give you my 2 cents. That's why I do these videos, which way they will go after earnings. And if the charts are clearly bullish or clearly bearish, that's the next direction. And again, I am not talking how Amazon's going to be trading tomorrow night in the after-hour session or even Friday morning. I'm talking where it's going to be a month, 2-3 months from now, and that's where I think it'll come down to these levels. You can see my first target's 149.20, and then 144.28, and then the primary uptrend line right here off the January lows. This was one of my favorite stocks back here in January. Positive divergence at support here on the weekly chart. It was at support, very good support. And I was singing this one from the rooftops. Amazon and Apple was 2 of my favorites. And that was it. In hindsight, I wish I just tucked them away and shut things down for a year. But either way, I didn't certainly milk all of it, but highlighted that. And where I'm going with that, guys, is I see in reverse, I see this is probably the best shorting opportunity that I've seen on this stock in years, other than right here when we were short right off the highs. We had 2 false breakout attempts above this trading range. Negative. We had a divergent high there. Yeah, it didn't do the trick. It gave us a little pullback, but the divergence got bigger at this point. And then the stock had its biggest drop in years, if not decades. It fell 56%. Right now, this is the first time, I've been looking, considering this a bear market rally pretty much throughout all of last year. Still believe it is. And but I didn't have as strong a case to make back then. Now you've got this big multi-month divergence right there. You've got sentiment again at extremes. The sentiment surveys, AAI, show that, but I can just turn the TV on. I can read the comments on this site. I can tell you this is really what you want to see for a major top. So, the little wedge break there on the trend line would be your first sell signal in the weekly, especially weekly close. Then this trend line, that would be kind of lights out stuff. Of course, go back to the daily chart, and you've got my purple levels, 123, and there's that uptrend line right there. NVIDIA, they need to kill this beast for the market to really go down. This is a king of AI, the poster child. And I can tell you from a technical perspective, it broke down. I've got to check. I'm going to see, when did they report? They did last, was November 21st. Okay, so we're coming up, and yeah, it should be soon. Okay, I've got to put that on my calendar. But what I can see here, breakdown, back test, and again, just big divergence. When you see it that long on the daily chart, you want to zoom out to the weekly, and then you can clearly see it. And so just like I know that, my calls for my, next drops are very aggressive, and probably few, if any, out there are calling that. I had the same call back here when the stock peaked and everybody was in love with it. Not even as much as now. It's more overowned and overloved. But these were the targets I gave you back then, well before anyone knew there was a bear market in 2022. Hit that T2 perfectly, reverse from there. That's what happens. T1 was hit, you got to bounce. T2 was hit, but then there was evidence to cover at that point, to cover the FANGs, to cover, the Mag 7. We had positive divergence on the stock market, so that's why we had a hell of a reaction off T2. But now we have an identical technical posture. Big negative divergence. You have this little megaphone pattern here, and this uptrend line that should seal the deal. This should be the seal the deal when we break that trend line, and then at the bottom of that megaphone pattern. So something like this is what I see the path for NVIDIA over the next year or two. All right, Meta, I just jumped. Oh, it's on a weekly time frame. You can see the big divergence there. Again, this is, I'm tell you, I try to keep emotions in check and trade. I'm actually excited. 2022 was my best year ever. 2023 was good. Not great, but okay, pretty good. Got in early, like I said, a couple times trying to turned the top and, got stopped out and lost on some shorts. But overall, I had a lot of other things offsetting there. Crude oil, natural gas, some metals, trades on the metals. So it was a good year overall. Kind of give it maybe a C for the equity markets, but everything else now, I think 2024, again, maybe I'm wrong, but I can see the potential to be one of those mega blockbuster here, especially, shorting the equity markets. And here's the takeaway. This was a divergent high. This was followed by a 44% drop. This was a divergent high. Many consider COVID a random, event, and by definition was black swan. But the charts were pricing it in. It dropped 39% right there in Meta, and that was off that divergent high. You can see there. I think you can see it right here. Yep, divergence, drop, divergence, drop. This is weekly. This was a big, beautiful, I think I referred to it back then as a beautiful bearish rising wedge. And that was one of the biggest drops I've met in years. I mean, I trade shares and mainly futures, but if you were an options trader, I mean, this would have made your career. 76% drop in Meta. And again, it's one reason I love stocks, shorting stocks. They tend to fall a lot faster. Meta wiped out in just a matter of, what is that, not even a year, about a year. It wiped out, go back to here, that's 7.5 years of gains. So this is why I look for these tops. This is why I look for bear markets. I know stocks go up the majority of the time, but if you can get in and capture these, shorting stocks from the major trends, even the swing trading we do, even quick pullback trades on the 60-minute charts, but basically you're trading like a bull market in triple fast forward speed. So you can make, as much money in a year, again, as you would have made on the long side in 7 or 8 years. Or maybe you don't short stocks. Maybe you just want to know when to sidestep, when to take some of your 401k off the table, move into cash. Some are all cash. I do give those macro kind of outlooks. We did with bonds, told you recently, off the lows and treasuries, took long-term funds and shoved it all, most of it, not all of it, most of it into bonds. And we caught that biggest bond rally in years. And so that's also another takeaway here, that you may not care to short Meta or short anything at all. But let me just draw a little potential trend line here and see if we've got a little wedge going. Yeah, we do. Looks like a little wedge there. So that's it. And so, based on the technicals, I'd see at least 224, at least. Actually, I'm going to move this line right now. I'm going to just add another line here, give you swing targets for those of you interested. And if you're not, if I don't get feedback, if there's not a lot of individual stock traders, most folks are trading the index, just that's fine. But just to give you targets, about 277, and then ultimately, if things get pretty ugly, 184. Who knows? I don't know if we'll take out that low in Meta. Meta fell a lot more than the rest of the fangs, but these are two high probability targets, very high probability. First, a minimum target right there on the weekly is about 277, and then 185. Let me just put it in percentage terms. That if that 277's hit, that's a 30% drop. That's very unlikely to see Meta drop 30% as one of the Mag 7s unless the market drops well into double digits. Okay, Tesla put in this divergent high, and that was it. That was the top in this stock. It's sitting on pretty good support right now, about 183.50 on this weekly chart. Took out my purple line. It's only, remember, it's no longer a Mag 7. This is a stock like Amazon that peaked over 2 years ago and is double digits, well off its highs. So that's why I've said the pool has shrunk to what I call the Mag 5 now. And if things go where I think they might, in a few months, we might have the Mag 2 or the Mag 1 or Mag 0. We'll see. Anyway, that's that. So I mentioned earlier in the video, Meta just hit. These are lines I have not updated. I've had this line here since 2020. Looks like I updated it. I don't know if I changed the color or put the number, but it's been here. Last time I updated, it says February 3rd of 2023. And so we hit that to the button. So again, when I do these videos, and if you want to, sometimes I don't update these lines when I need to, over time I need to tweak them a little bit. And if you were a Tesla trader or holder, long-term investor, and you want to, hey, Randy, can you update the chart on Tesla? Show me support levels. I'm looking to buy it. I'm a bull. I want to buy it, or I want to short it. I can give you the objective levels, support and resistance levels. You can see, for example, there's a trend line here. So if after Apple and Amazon are out of the way, if the market likes what they're selling, and then of course in the Fed, and Tesla breaks out, there's a trend line right there that can provide a long entry. And then there's a big gap to be backfilled. And this is the deepest overbought reading that Tesla has had since right here. And you can see what happened at that point. We went all the way up here. So, that's why I said earlier in the video, I wouldn't short Tesla with your money right now. I'm not saying it's not going to continue lower. It's certainly in a downtrend. But with that overbought reading and bouncing off support recently, and if I'm wrong on where we go post earnings here and the market continues higher, then this one's probably going to play at least have a bear market rally that will, certainly has a potential. I mean, there's your bear market downtrend line right there. So if you ask how far it might go, well, there's your primary bear market downtrend line. If it wants to check it again, then from where we're at today, that would be about a 38% run to get up there, give or take. Okay, there's Broadcom. What I've done now, I'll stop here because I'm beyond the Mag 7 or the former Mag 7, whatever you want to call it. But I'm clicking in order. When I do these videos, I have the watch list or the components of the NASDAQ 100 sorted by market cap. Microsoft's now first. Microsoft and Apple are still both right around the 3 trillion mark. But there's this one's worth noting, Broadcom and Big Semi, obviously. There's that purple line. That's my first purple line. That's my last line in the sand, about 767. That's a heck of a ways down there. So, but you have a minor trend line here. So the way this works is sell signal number 1, break, swing it down to 1042. That would be, if it broke today, let's just say, for example, that'd be a drop of about 11%. Then I put high probability on a bounce off this trend line here and price support. They come in together. Boom. And then your next signal comes on a break of the trend line and or that 1042 support. And so that's how I'd see that one playing out. And that's a very likely scenario based on, I think, that both the technical posture, the sentiment, and I'll leave it here. I've covered quite a bit lately as far as I've covered some sentiment indicators, a lot of breadth indicators. Recently did a video on that. I've talked for a long time about the 100% so far historical prediction rate of recessions from the yield curve, inverted yield curve. And again, it's not the inversion, it's the uninversion, which hasn't happened yet, but certainly appears to be. Then I came across this article reading from the Motley Fool. I'm going to put a link in the video and let you read it, but there's a lot here. This whoever wrote this, I'll give them points. I haven't vetted this, made sure everything's accurate, but pretty compelling. And again, what this author did is put together a handful of recession indicators with just either perfect or near perfect track records. And again, I'll let you read it. This is the LEI, gives a chart, read up on it, but they're all predicting, and these are high probability, at least again perfect track records on a lot of these. There's the LEI, I believe, yep, the LEI. There's another recession indicator from the Federal Reserve Bank of New York, their recession probability tool. This was the LEI up here. Where was it? Again, I've just pulled the article up right now, but that's pretty high. And again, they show you, they talk about the history, they talk about M2. I've known that. I've been reading about this lately. The contraction in M2 money supply. They tell you what it is. Read up on it. This video's gone long enough, so I'm not going to go through each and every one of these. But anyway, some pretty compelling, if you will, things that show that are in contradiction with the majority who think that at worst case scenario, we're looking at a soft landing. But again, just about everybody has taken off the hard landing thing off the table. And to me, I haven't. And there's a lot here that tell that, a recession appears imminent and likely as in 2024, as in it could have even already started because they're always declared in hindsight. by the NBER. All right, I'm going to wrap it up. Again, I'll put a link in the under the video for this for those interested. All right, this has been Randy Finney with Right Side of the Chart. Let's see what the market does after the Fed today, and then again, Apple and Amazon tomorrow. And by next week, we'll have a good idea where this market's going. And if it, if it wants to go up after this and holds up after earnings, after those big fangs in the Fed, I will make a point to put out more long side trade ideas for those of you that want to, continue to game this rally. But I don't think I'm not putting a lot of individual trade ideas out right now in front of all that we have going on this week. So next week you'll get some new trade ideas, be they maybe longs, maybe shorts, maybe a little of both. All right, wrap it up here. Again, this has been Randy Finney with Right Side of the Chart. Have a good day.